Today we are talking about Crocs stock. Everyone loves Crocs, or maybe you don't love Crocs, but maybe your kids love Crocs, and they do have normal looking shoes these days, so they're not just the old school looking Crocs. If you don't like those, there's other types of great looking styles coming out from this company, and today we're going to talk about my valuation of this company. I used a discounted cash flow and an EV to EBITDA valuation to figure out what I think this company should be worth. I'm going to give you the actual target price today, and I'm going to tell you I actually bought some of this stock just a couple days ago. So let's get started. Let's talk about my valuation for the EV to EBITDA valuation. So here we go. This is what I think Crocs is worth. This is based on an enterprise value to EBITDA valuation. Now, remember, I'm going to do two valuations. I'm going to weight them both. So this is not the final price target I have. This is just one of them. Now, my selected price target that I think Crocs could potentially be worth right now is $163 per share. You know how much of an upside that is. That is a 124% upside. Now, do I think it's going to happen right now? No, the sentiment on the stock is not very good. However, I think that it's potentially worth that much money. So next off, while using EV to EBITDA, remember, not after I look at the discounted cash flow, we'll see the next part. But if we hold this until 2026, I think it could be worth $420 per share, which is a 42% rate of return compounded annually if you held it. So I think Crocs, based on this, is a potential resounding buy. Now let me tell you what I got and how I got it here. So if we go through the different steps, the first step is to find the shares outstanding. I have them buying back stock at 3% every year. What have they been doing? Well, the average buyback of stocks has been 3.77% at all these different time periods. So I do have them at 3%, a little less than the average, closer to the median. Then we have the Ebitda Growth. This is step 2. So looking at Ebitda Growth. Ebitda Growth has been incredible for this company. The median growth is 91% and the average is 92%. These are close, so that's good. Not any crazy outliers I'm seeing here. If we look at the past 3 years, 96, past 5, 87, past 9 years, 16% growth over the past 9 years compounded annually. That is really a great number. So when I go and I forecast the EBITDA of this company, what I do is I say, okay, let's give it some decent growth in the first year. I got 25%. Remember, 171% was last year. Over the past 3 years, it's been 96%. I am giving them a decent growth rate. However, I did lower it a little bit less than what I maybe would have done before this bear market was going on. So I gave it 25, I gave it a 50%, I gave it a nice growth rate, and then I have it completely going down to just a normal growth rate, 15% EBITDA growth. Now, if I even change this, it doesn't change it too much. This is still a great potential stock to buy based on EV to EBITDA, but this is what I have. I'm going to show you down here what I get with the multiple. So if I take a look at step 4, I want to use a multiple for this. So what I do is I say, okay, these are the different multiples in the different years. The average multiple has been 17 and median's been 18, so they're close. I did a very low multiple comparatively speaking. The 2021 multiple was 11, so it's a lot lower. And then we got over here, I used a 12. So a pretty low multiple. According to the past, it's very, very low, so I think that's conservative. And we get $163 price target here, going up to $420. This is a pivot table, so if you do want to see different potentials, you can look here. So if you think that there's going to be a lower multiple, just what if you thought that? Well, if it's a 6, this company's still fair valued, and it's still going to give you a 23% return over the next few years, right? If it's a 10, it's better than fair valued. It's 86% upside right now, 36% compounded annually over that time. Now, let's go back. Let's say I kind of change this and I go with, okay, let's say instead of a 50% growth rate, we go down, it's a 15 instead of that. What happens? Well, you still have a very good growth over the next few years. So I still get a 34% annualized growth on this company, whereas before I had a 42% growth. So it is lower, if you do reduce that EBITDA growth, but it's still not that much lower. That I think this company definitely has some potential. Let's take a look now and see what's going on in some other things. I usually do something called a Cat5 Score that I created. Now, I'm not doing that in this one. I am going to go over some important things for you, though. First off, we have the PE ratio of the company versus what's going on within the industry. So I have about 8 different companies I'm comparing it to, and the average of all those companies are 19. So this is a much lower PE ratio, which is very good, and the median of those companies is a 10. So it's way below the PE ratio there. If we take a look at the forward PE, it's way below also the industry. The price of sales, it's below the industry by the average, but a little bit above it on the median. If we go down to price to free cash flow, it's also way low at a 10. We have a gross margin way higher than the average in the industry. We have profit margin way higher than those in the industry that it competes with. We have sales growth at 17% higher than the industry it competes with. We have earnings per share growth over the past 5 years higher than the industry, and the debt to equity, which is high, 8.24, which I do not like, which is a little potential that could be the main negative of this stock, the debt. Okay, let's go ahead and do a discounted cash flow, figure out what the price is based on that. So if we look here, we have a 76.80% return in free cash flow over the past 5 years. That's how much the free cash flow has grown and compounded over 5 years, and over past year, it's up 18.30%. So that is very good growth on free cash flow, very good growth on the 5-year and the 1 year. So what am I doing? I'm not going to go with like a 76% free cash flow growth. That's too much. I'm not even going to go with a 1 year average of the 18.30. I'm going with a 13% free cash flow growth rate. I'm going to say that if this happens over the next 10 years, so if Crocs can grow its free cash flow at 13% 10 years down the road, and I put a discount rate of 9%, this gives me $141 for the stock. It's a 48% margin of safety. I like to see that at about 25%. Do I think Crocs can potentially make this much money? Do I think it's worth this much? I think it's close to that. I think it potentially can be. And what I love about this is I have such a giant margin of safety here that if I am wrong by, quite a bit, I still have some wiggle room here. So I could be really pretty wrong, and I still maybe could potentially not lose too much money over the next few years. So that's what I got here. Let's go and let's weight this and figure out what the actual price of this company should be. So here I have the free cash flow based discounted cash flow. I'm weighting this 60%. So free cash flow is more important probably than EV to EBITDA. So I'm giving it a higher weighting. That's $141 for free cash flow. That's how much that methodology gave us as a target price. Then we have the EV to EBITDA. We have a 40% weighting here. We have a $163 price target. This gives us a $150 weighted average price target for this company. We have upside potential of about 100% on this company from where it is today to where this number is. So if you like Crocs, if you think it's a good company, if you agree with this, potentially something to put on your radar. Do your own due diligence, of course. This could go completely wrong. This is a very volatile stock. I'm going to show you the chart real quick. Okay, so here's what we have for Crocs. Crocs has had an incredible run-up and an incredible round trip, almost round trip, all the way back down to the pre-pandemic highs. It's actually almost right there at the pre-pandemic highs. Currently, it's off of those a bit, but it got down as far as that. So, essentially, you lost 2 years of growth for this thing, and now it's only up a little bit. So let's look back and see what's going on. Let's talk about how much this stock has fallen since this time period. Now, if we go here and we say, 180 area, we draw this down and we say, okay, about 47 was the low. We have a negative about 74% drawdown in this stock from the peak of it to this little trough that it was in. And now since then, let's go in, let's zoom in a bit and see where we are. So if we draw this up right here, we go up to this little area we are right now in the 72 area. We are at about a 60% upside since this low period, right? So this is what's going on in this stock. As these stocks fall further and further, the big jumps, the jumps in between these little smaller numbers comparatively can be absolutely huge, and they can annihilate you if they go to the downside, or they can be really good if they go to the upside. So this company is reporting earnings coming up. It is reporting earnings on the 4th of August, 2022. Estimated $2.67 for earnings. Estimated revenue of $245 million for revenue. So let's see what happens with this company. But honestly, this company has been down quite a bit. It is currently up quite a bit, just relatively speaking to where it is now in percentage terms, not relative to where it has been trading before. And remember, my target price here, it's about 150. Last thing I want to show you, let's see if there's anything going on in the indicators. So if we throw on just some simple moving averages, we have the 50, we have the 100, we have the 200-day simple moving averages. If we look down here, this thing is yellow. Wait, that should not be yellow. Hold up, let me change that. That is hard to see. Okay, so that's better. We have the 50-day moving average here in green. It is now trading above this 50-day moving average. It acted like resistance. You can see a little bit. It's acted like resistance in many different areas, so it could potentially be support right now. We also now have this other moving average here. We have the 100-day moving average that is also trading below. It is trading below the current price, so the price is above it. And then we have that 200-day moving average up here. So potentially, if it can stay above these moving averages, potentially could go up further, and maybe there's a little less resistance. We're also talking in this area, I'm seeing some run-up potential up here until the 83 area, 84 area, before I see some pretty big resistances. So let's see what happens on that. And the last thing we have, which is actually important, that is not looking good in my opinion, is the fact that RSI is pretty high. Absolutely, it is above this 70 area. So if I'm looking at this on an oversold, undersold type, overbought, oversold type basis, I'm gonna say it's possible that this thing falls down back to the lower part of this little shorter term uptrend that it's in, potentially coming down to the top of this downtrend channel line. So if that happens, we're looking at a possible price of, let's say, $60, and then that would be about a 17% decline. So what do I think this company could do? I think in the short term, this company could come down a bit. Easy potential for this company is to fall 17% down to this area. But then I do think over the long term, I do like this stock. So that's what I'm saying. The stock's volatile. The stock could go a lot further down right now. Sentiment is not good. So if you're weary of losing lots of value, but not if you're okay not selling, this could be a good stock for you to at least hold and not too much of your portfolio in. But remember, this thing has the potential of really falling far. So anyway, hope you like this video. Remember, hit that like button, subscribe, see future content like this. Watch another of my videos coming up right now on the end screen. So watch it now. Thanks everyone so much for watching. I do want to remind you, I'm not a financial advisor. This is not financial advice. This is just my opinion. And let's face it, I am not right 100% of the time. So please do your own due diligence.